welcome back to another interview, and this time we have John Polomny. So nice to have you on here. Can you just talk a little bit about yourself, introduce yourself to the audience, your background, what you're doing? Yeah, that's about it.
Well, so my name's John Polomny. I'm just what I call myself as a guy on the internet. I was somebody that started out, with basically nothing, and over the course of my life and experience in investing and working in different businesses, built myself up. I'm retired now. I manage my own portfolio, but I also, because of this Bitcoin thing that started many years ago, some people called me and aggravated me about it. I wasn't a big fan of it. I saw kind of the first time it spiked up, and it was kind of gave me reminiscence of different bubbles that I saw. So I kind of started getting on the internet and talking about things and trying to get people to think more rationally about long term investing versus speculating, trying to differentiate these things. So that's kind of where I'm at now. I'm retired. I manage my own assets. I think I have learned a lot through the years, and I try to help other people be more realistic and consistent in investing and creating wealth over a long period of time. So that's kind of what I do now. That's kind of the short and skinny of it.
Mm. Yeah, and before sort of delving into these other topics, I saw you discuss a lot of times how the resource sector is not really a good place to be in as a general, let's call it newcomer or somebody trying to play that space. So can you just sort of talk about this a little bit?
Yeah, the resource sector, for most people, they should stay away from it. Like mining and resource extraction, if you look at it in its totality, uh, it's basically a net destroyer of capital. But and what attracts people to it is there are short periods of time because of the cyclicality associated with the investment cycle inherent in resources, which leads to oversupply and undersupply. There are periods of time uh, where you can speculate and I guess you can call it invest in the resource sector in certain resource sectors at the right time, having enough knowledge where they will have periods of excess profits and cash flow that you can take advantage of. But this is not as easy as a lot of people make it out to be. And it's very dangerous because it's mostly speculation. I encourage people, if they really want to get involved with this, they have a lot of these resource conferences. People should go to one of them. They're in Vancouver and places like that, Toronto. People should take a trip up there and they should go to this thing. And yeah, you can listen to the lectures of the typical people you see on the internet, but they should walk through the hall because they'll have all the exhibitors, all these mining companies or junior oil and gas, what have you. And you can stop and talk with these people and you will be amazed that all of them have a story. All of them have this asset that if you just, give them your money, they are going to make you a multimillionaire. And it simply isn't true. And so I think for somebody that's new to investing, investing means having consistent returns over time, return on your investment. What a lot of this stuff is in resources is unfortunately is more of speculating. And I think a lot of newcomers, they get attracted. There's a lot of people that come into investing and they want to get rich quick. I think a lot of the crypto things, a lot of this tech rallies that we have, these bubbles, they cause outsized returns and it attracts people. And then it lends itself to all kinds of psychological. I mean, the
Yeah.
average return for stocks over time with dividends invested in the US is 9%. If you can beat that, you're doing well. But, this is not what people want. They see their friend or their ex brother in law at a family gathering bragging about how they bought NVIDIA and the guy's a complete moron. So they think, well, this guy's an idiot and he got rich. Why can't I get rich? And so this starts the problem. So I think that's one of the problems with resource markets. Obviously, it's very popular. It's a very shiny object that attracts people, just like a fish. When you're fishing, it stimulates people to
Yeah.
let me put this $1,000 in the stock, and it could go to 100,000. It's just not how things really work in real life. I think that's the big problem.
And it takes a huge amount of know-how. I mean, even just being able to analyze a normal business takes a huge amount of knowledge, and then on top you put the commodity risk, you put the geopolitics on there, and it's like so many factors you have to look like. It's really something, and you have to also be aware of the capital flows, right? I mean, you can't just go into that sector without being aware how capital effectively changes that sector. For example, the supply of financings being done in the sector, how that changes the markets, right? But yeah, sort of getting to a part of a discussion, which is geopolitics, right? So you've described sort of the 2020s as sort of a Cold War free type situation between the West and the BRICS nations. So as the US continues to sort of, embark on this sort of political plan that they have, which is sort of a winner takes it all competition against China for resources. How has this sort of changed the function of gold as a reserve, and perhaps how has this impacted, in your view, the the relationships and the dynamics of the sort of the relationship between the US, China, and let's call it the European Union? I know it's a
Well,
hard question. It's not an
yeah,
easy question, so
this- yeah. I
we might
mean,
want to break it down in manageable chunks, right?
so I think it was interesting. You can do a search on this. I wrote in an article last month in my newsletter in the commentary section, which I leave open for people. And I talked about this. One of the things when I was a working person, I was in a collective bargaining union and I was officer. So I was involved in negotiations with the company for benefits and all this stuff, contracts. And one of the things, our union spent a lot of money and time training us about negotiations and what other, how you should act and what you should do in negotiation.
Mm.
And what I noticed was that it doesn't matter that if you agree with somebody else, but you should at least understand what their perspective is because you're trying to achieve a certain outcome. But if you don't even bother to consider what the other party is trying to achieve, you're not going to have good results. And so I say that as a preface because I think that, the post World War II neoliberal world order, you can go like on Grok or Chat GPT and put that in there and write about like what does the global South and East think about the neoliberal post World War II global, and then you'll see officials
And the
from
world
China,
police, right? The world police, which is the US.
and they will tell you you'll get all these quotes because people have given speeches and talked about this that are people in the global South and East, which is about if you take out the OECD countries, which are what I call the current hegemon that's struggling right now, that's about maybe 800 million people. So you have 7.2 billion people that are not part of this neoliberal world order, whatever. And so, for example, what one of the Chinese leaders has said is like, what is this neoliberal world order? What are these rules? Rules based order. What are these rules? Who makes these rules? Who do these rules benefit? And, people will say, well, somebody that's not a thinking person or doesn't care, most people don't really even think about these things. Well, what do I care what somebody in China thinks? Well, you should care. Uh, you know, uh, they basically, as Louis Gove has said, any industry that they enter, the profits leave the door. So they are a manufacturing colossus. They are a, you know,
Also
large population.
technological leader in certain
Exactly. So
instances.
they're, emerging, 40, 50 years ago when these countries were nothing. And so they could be easily dominated. They didn't have any power. They didn't have any economic significance. Well, that has changed and that's continuing to change. And so as these countries emerge, they require to be acknowledged, their wants and needs, their stature. These things are, going to be concerns for them. Somebody that's in charge, people don't seem to understand this in the U.S. or the West. My perception is the leadership in the West doesn't really care about the people in its own country. They care more about this world order, this more globalist, to maintain this hegemon, to maintain this advantage that they've had. You see that all the time with policies that are made that are contrary to the well-being of the people. And I don't necessarily see that all the time. Now, am I saying these people are good? Look, all these people are sociopaths. If you break it down, it's just how it is.
Yeah,
So I'm not trying to be glib. It's how it is. But what I'm saying is, you have this rising political, social, economic block of people that, I mean, there's a historical thing here too. A lot of the countries in the West, uh, people may not agree with this, but they exploited these countries, and that's how a lot of the people in those countries feel. So there's a historical animus. There's all these things going on, and now they're emerging. They're saying, "Wait a minute, we're not going to be dictated to. You're not going to tell us our way or the highway. We're just not going to do. You don't have the power to do that." It's kind of like in the Godfather when Mo Green says, "Look, the Corleone family doesn't even have that kind of stroke anymore." So it's kind of the same thing here, where we run around and say all these things, but we're one carrier being sunk away from the whole facade collapsing. And so that's my view. And so you're already seeing that being manifested in the fact that, look, a large portion of this is based on dollar hegemon being the world reserve currency.
I'm sorry to
Uh,
barge in, but we also saw this at the Munich Security Conference in a sense when Marco Rubio started talking about, the sort of old post World War II order, the communism and all of this. This was very reminiscent of sort of old, let's call it more traditional Republican views, right?
Well, yeah, he's basically calling for a no, like a return to like colonialism almost.
Yeah.
That Europe and the U.S. should go back to well, this is being thrown off. Look at what's happened in the Sahel, Niger, and some of these other countries. They've kicked France out.
and
Okay.
and essentially the reception in Europe was like everybody clapped on it. Oh my God, this is now so much different than what JD Vance said a year ago, right? So
Well,
they all appreciate that old world orders.
yes, because they benefit from it, and so how is you know I look at the United States. One thing that changed my view on these things was I saw in the 70s when things started slipping, when these countries started emerging. I had a lot of relatives that worked in the steel industry, and they were bitching and moaning because they were losing jobs, the competitiveness, the productivity. Well, they had these rolling mills that were built in the 20s and 30s that were not, Tyson Krupp could take a continued casting machine that they built, state of the art, put it in Brazil, have 8 guys make the same amount of
Mhm.
steel that a 200-man mill was making in Buffalo, New York. It was not competitive. So they bitched and moaned about it. But in the end, it was, it's Schumpeter's law, competitive replacement. So, anyways, getting back to what we're saying here is these countries are emerging. They're not going to be, they want their say. They want to be recognized. They want to have a place they have interests that are important to them, and they're not going to be sidelined, and they don't have to be anymore. And so you're seeing, for example, to get with respect to gold, you're seeing, for 30 or 40 years, the reserve asset for many central banks was um, Western Treasury securities, specifically the U.S. Treasury securities and the U.S. dollar. Well, if you are constantly telling China that you're going to attack them, as the CNO, former chief of naval operations in the last administration, said the Navy needs to prepare for a blue water war with China in 2027, why would you own U.S. Treasury securities? And so you're
Yeah.
seeing, when you saw I think what will go down as a historical turning point, when you can like point at, like kind of when Gordon Brown was selling the UK's gold at the exact bottom of the gold market in 1998 or
Yeah.
whenever it was at $270 an ounce. These are like the same thing as when, we confiscated Russia's assets. Even during World War II, the United States didn't confiscate the Axis powers' assets. And so, notwithstanding the fact that people can make whatever moral thing they want, these other countries have agency. And so they say, okay, well, if you're going to confiscate $300 billion of Russia's assets, maybe if I do something you don't like, you'll confiscate my assets. So since then, you've basically seen, and even before that, an increase in slowly running off U.S. Treasuries as they mature or not buying the same amount and replacing that with gold. If you look back
Yeah.
historically, 50 years ago, gold was 50, 60, 70% of some central banks' reserves. So I think, specific to your question, to kind of, I mean, this is like a 4-hour lecture if you really want to get into it, but
Yeah,
for the
yeah.
time we have allotted, that's basically how I think about this. And so, yes, that's kind of like one of the stimuluses that's constantly there, that low
Yeah,
grade
it's like
fever
a
below the gold price. Yeah.
it's like essentially like a how would you say it? It's like a bottom sort of like it's essentially establishing a bottom for the gold price, like a price where it cannot fall below, because you have this a certain amount of constant buying of central banks, which is I think 50-60% higher uh like like it's higher than pre-COVID situation. So 40 to 50, I think 60% even higher than pre-COVID situation. And essentially gold is like really only, you could say it's like the biggest asset class where you can really park your money in when you have a lot of it, and it's liquid enough to also get it out. So this is one of the major advantages, that you can just basically, for these central banks, go in and sell it. And you've also noted that you use these sort of extremes sentiments in the gold and silver price to sort of as to have an idea of the cyclicality, right? So with the resource market having been at $5,500, right, and it had that big drawdown of 20%. Like, how do you see the current sentiment, and what is sort of your view on gold price currently, and as well as silver?
Yeah. I mean, pretty much for all of these things, I kind of use technical analysis, not to predict, but kind of show me where the sentiment is. And like, I use the moving averages specifically because what I have found, if you, and anybody can do this exercise, is look for gold, for example. When your 200-day or 200-week moving average is in an uptrend, that you're in a bull market. And if your 50-day or 50-week is trading above that, I'm just giving simplistic things here. You're in a bull market. But what happens is because of FOMO, because of sentiment extremes, because of the nature of capital flows into in and out of these things, and FOMO, these things are very volatile. And you'll see, like we had recently, what happened in gold, where the gold price went nuts. When I have people lining up in the street to buy gold, to buy that one
That's
tenth
a
of an ounce,
signal.
yeah, you should not be buying gold then. And you see that the price is 2 or 3 standard deviations above the moving average. That thing acts like gravity; it pulls it right back down. So I think that the price moved. I think, let me be clear. I'm a long-term bull on gold. I think gold's going, just for the some of the reasons we talked about,
Mm.
and it's going much higher. But that, in the context of a secular bull market over a decade or more, you could have cyclical periods of
Yeah,
time, 6 months,
30%
a year.
drawdowns, right? We saw it in
Exactly,
the 2000s.
exactly, and that goes for every commodity. Uranium went through the same thing. Oil goes through the same thing. And so you just have to be cognizant of that. The problem is that, and I think this speaks to a question you're going to ask me later, so I'll stay away from it right now. But it's
Mm.
just the nature of these things; they're very volatile. And I hate to use other people's comments, but Rick Rule has said this many times: you must make volatility your friend, or it is your enemy. Because what happens to people is that are inexperienced and have a low emotional EQ. They get into this and they get on social media. Social media didn't exist when I started investing. And maybe the first thing you had was Yahoo message boards. That was it.
Yeah.
It was stupid.
Or Stockhouse.
Yeah. So everything now is instantaneous. Everybody has an opinion, and it can start feeding on things. And so people, being a herd animal, people seek that, to help justify in their mind, oh, I should buy now because everybody else is, it's going up. Why am I buying gold now? Because it's going up. Well, if that's your conviction, then you're really a trader, a speculator, and that's fine if you want to do that. But if you look on the Fortune 500, there isn't a lot of speculators that are on the world's wealthiest group. So I
Mm.
think understanding some of these things, and it goes back to what I say all along. You really have to understand why you own something, what you own, why you own it, and what you're trying to achieve. So I think gold is real money. It's been that way since the history of mankind. It's reasserting itself in that role now, and I think that's going to continue, notwithstanding the fact that it will have volatility extremes, which can be taken advantage of. So right now, we're shaking out the previous move. So I wouldn't rush back in right now, but I do think that, I do have a list of, I own one gold stock. It's kind of a gold bank property that's not really producing. They'll eventually get bought by somebody, but I will at the right time re-enter. I mean, look at the recent. If you think gold
Mhm.
is going to maintain these levels or trade above 4,000 to 5,000, something like that, look at the earnings and cash flows of these companies that have reported over the. This is unbelievable. Some of these companies, the cash flows that are just pouring out of these companies. So, mining stocks, I think, are an opportunity, not necessarily the metal here. Gold I buy as wealth preservation, and it's something that I buy and probably will never sell. Silver,
It's like a hard asset, right? It's just
yeah,
something that
exactly.
keeps on.
I mean, I'm not going to get into my family history, but
Yeah.
it saved lives throughout history of being able to cross. We can get into all that. So,
Mm.
not with that's kind of my view on gold. And but I think that people need to be careful because they get swept up in these manias.
Mhm. And what a lot of people don't realize is that, and you also touched on this like a little bit, is sort of the capital allocation issue, right? I mean, mining CEOs, you'd think they would learn through all these cycles, but they somehow still have that feeling of, oh, now the price is so high, now this is the time to conduct an M&A phase. This is the time when I should maybe not return money to shareholders and actually try to do a good capital allocation, but rather invest in something that might yield me a return in 15 years.
Yeah, a perfect example. I pointed it out as the recent. That's what these
I,
guys always do. Was
mm,
Agnico Eagle CEO back in September? He said, "Oh no, we would never," because they know the cash wave is coming. Oh no, we're not going to do what we did in the past, what the industry does. And so, what did he say during this last conference call when they had billions of dollars of cash flow? Well, it may be time for some M&A. They just can't help themselves. So this is what they do. So, but
yeah,
this could be to our benefit because I think that, if you've actually participated in a mining stock or a gold stock bull market, it can change your life generationally. Not only your present life, but your children and grandchildren's lives, because you can create generational wealth during one of these. As Doug Casey has said, a gold bull market is kind of like trying to put the contents of Hoover Dam through a garden hose, and so when the capital comes into these things, it can be
it's
tremendous. And
violent,
it, yes,
truly.
very, very much so. So yeah, that's kind of how I look at it.
Yeah. And while sort of these sectors were breaking out, we've also noticed recently oil sort of changing, and the oil price and also the sentiment around it getting better, but it is still largely out of favor for a lot of people. So why do you believe that oil is sort of a commodity where it's essentially, at least for the next coming months, years, impossible for oil not to participate in this cycle that the precious metals have been enjoying the past few months?
Well, I mean, this is a very difficult market, oil market. You're right. It's actually kind of energy overall has kind of outperformed so far in 2026. It's kind of what I look for is sectors that no one talks about, no one cares about, and is very cheap. And if you go back and look at my work, I mean, even like a year and a half ago, I was telling people to buy the large cap, what I call crown jewel companies. This is where you need to start. It's the same thing in the mining sector. When something's completely out of favor, I don't need to go down to the shitcos on the Canadian Stock Exchange secondary markets and try to find XYZ company that has a $10 million market cap when I can buy, you know, Newmont or Agnico Eagle when they were a third or a quarter of the price they are now. I understand that these things are in a long-term bull market, and then there's a capital cycle here where the initial money comes into the large caps, and then as the bull market proceeds, gravitates down, percolates down through medium capitalization, and finally into the small caps where the real torque comes. And so there's an evolution that happens. And so, I believe that we're in a commodity super cycle. The previous one that I enjoyed was in the aughts. That was driven by Chinese demand when it entered the WHO. It was like a black hole sucking in
Mm.
with tremendous gravitational power all commodities. Now I think we're in a situation, if you listen to anyone that's in any of these companies, if you want to listen to Robert Friedland or any of these oil executives, you had tremendous amount of underinvestment for decade plus 15 years in all these sectors. So I believe we're in a demand driven super cycle. Um, and I don't need an AI revolution. I don't need a data center build out. I just need 2 to 3% economic growth in the emerging markets to continue to do what they're doing. I understand that to have a certain level of GDP in India per capita, I need a certain amount of copper consumption per person.
Mm.
These are spreadsheet exercises. The copper doesn't exist. The oil doesn't exist. But
And sorry to intervene. We've also seen the emerging equities outperform the US this year, right? So there's been some very strong demand for everything outside of the US, really.
yeah, I mean, so this is partially with a little bit of a weaker dollar, but I think it's an acknowledgement that a lot of these emerging market countries are, commodity producers, so they're going to benefit. So it's basically an underinvestment, capital underinvestment story. And I think that if you believe that we're in a super cycle, and if you look across the commodity complex, resource complex, just about everything now is breaking out. If you feel that if you have a view that we're in a super cycle, then this would be the first time in history that oil would not participate. I think sentiment has been very negative against oil. I think that the zeitgeist, the view towards oil has been wrong. And now that's being changed. It was the same thing I saw in uranium 5 years ago. Nuclear was going away. It's dead, blah, blah, blah. Well, look where we are now. I mean, every country in the world's building reactors except for Germany, which will eventually start building reactors again, too. Anyways,
Mm.
or importing electricity from France or Poland. But, anyways, that's a whole nother story. But the same thing will happen in oil. I mean, where's this 4 million barrel a day surplus at the IE? I mean, this is all nonsense. So,
You think
I'm not a
so?
big
I mean, the reports are out there. I mean, it doesn't hit every market the same way, right? You have to
no,
be aware of that.
that's correct. But um, what I Josh Young and I talked about this on another interview the other day. It's hard to get the exact point. I don't need oil to go into deficit to make money. What's wrong? I mean, I gave this example the other day. You have the Canadian oil sands, for example. Okay. You're trying to be an investor. That means you're trying to beat that 9% a year.
Yeah.
Last year, all those oil sands properties have been built and amortized. Most of the debt is being paid back or has been paid back. There's no major projects coming online. So they require maintenance capital to keep the operation. They're basically a manufacturing operation now. So you're getting 60, let's say you get $60 a barrel. Okay. So they had 25 billion, all of them together in Canada had $25 billion last year in maintenance capital. They had
Hmm.
almost $60 billion in free cash flow. They're not going to build any more plants. There's no pipeline takeaway. What do they do with the extra cash at $60 barrel of oil? I don't need 80 or $100 billion oil to make with dividends and buybacks. I've bought some of the oil sands. It's what you pay for these assets. Okay. I don't
I mean, they can also technically substitute, right? I mean, if they sell to the US down, right, they get a huge discount for their oil, whereas if they
absolutely
export it
there's a
to other
discount.
places, they can increase their margins, for
I'm
example.
just using this as an example
Yeah.
of how you have to look at these things, okay?
Yeah.
And so if I think that oil is going to go higher over time, which I believe it will, that we're in a cycle where we're going to see higher oil prices over the next 3 to 5 years. I don't have to get it right because I'm getting paid to wait. I'm still going to get a long-term return. And so even if I don't, it's not like I'm not like running an energy fund like Josh or Eric Nuttall, where my
Hmm.
my my whole thing is 100% energy. Of course, I don't ask a barber if I need a haircut. I don't ask an energy fund manager if he thinks oil's going up. Okay, so I mean, it's obvious that if you're running an energy fund, you're going to, I've been involved with a lot of oil and gas exploration and people in the industry. I've never met an oil man that wasn't bullish on the oil price or didn't want to drill a well. This is
Yeah.
how it is. So, I mean, you have to go into it looking this way. So that's kind of how I look at it, notwithstanding the fact of some other commentators. I don't commentate on what other people say. I know I've listened to Doomberg. I know his views. I listen to Art Berman. I listen to all kinds of
It's
people.
just a different perspective, just another consideration.
Exactly. But if I mean, I'm getting, if I can buy the best company in the world for like Exxon, like which was a company I told people they should probably take a look at if they had any interest in oil. I'm getting the
Mhm,
best well-managed oil company in the world, the best allocator of capital in the industry, and one of the best managed companies in the world. They've demonstrated that. So if I make it 3% of my portfolio, I probably am not going to lose much if my thesis doesn't play out, but I have possibility of definitely outperforming with the S&P with that capital. Then, if my
mhm,
thesis takes hold, then I can migrate down into more speculative areas, just like I have done in gold or copper or what have you, or uranium. Okay, as the thesis
mhm.
takes hold and becomes more solid, then you can say, okay, well, this is actually playing out. It's time to migrate down into more. Different companies or positions that have more alpha. So that's kind of how I approach these things.
Would you say this sort of, I mean, certainly the migration is already started to a certain extent, but from my view, what I saw even during the crazy highs of 5,500 US dollars, I still didn't get the impression that, what one would say at the end of like the whole cycle, that, oh, everything is flying, even the worst kind of projects. So even that I didn't really see. So in my eyes, also agree that this is perhaps a longer cycle, not just what was like this first leg up, you could say, right? I mean,
Yeah,
it's going to be very volatile, as you said, right? I mean, there's no question about it.
yeah, it's going to be multi-year. This isn't something that's just going to happen on one spike. I mean, you have these spikes, then you need to digest them, and then look. I tell people, what are the what's your conviction? Write these things down. Why am I buying this? I'm not buying junior gold mining stocks because somebody on the internet told me to buy them. I'm buying them because I have the experience. I've been in a gold bull market before. I've seen what has happened. I have a thesis, a view that the gold price is going to move higher over time. That's going to move high. People need to be careful because what they don't realize is what happened in the last gold bull market. If you're in a commodity super cycle, guess what happens to all of your inputs into your mining operation? They go up too. So if you're trying to build a mine and bring it online, because everybody and his brother now, I can give you 20 different juniors that have one mine operations that are trying to bring them online now that are either greenfield or brownfield operations.
Yeah,
So capital's flowing, okay? Economics works, but where do I get the miners? Where do I get the ball mill? Where do I get the copper wiring? All these, all this stuff costs more money now. And so what does that do to my margins and stuff? So, the margins right now are very, very good because the rest of the inputs are not that haven't really moved yet, but over the cycle they'll start to move too, and people will be shocked. Well, I don't understand why the margins are shrinking now,
yeah.
and this is all these things you need to be people
And
need to
all
be
the
cognizant.
being aware of the grades and what
Oh
part they're
yeah,
mining, that
absolutely.
can all affect the costs and the margins and ultimately the results, right?
Look,
And
look, look. I mean, look. This is what I say. You get involved with a mining stock. Everybody's trying to wreck the project, not deliberately, but that's just how it seems. The government is going to want more revenue once the price goes up. You could be in Mexico. We just saw a recent example with a very darling company where cartels kidnapped 10 of the people and
yeah,
shot them in the head because they didn't pay
yeah.
money. This is a Canadian company, okay, by the way. So, I mean, there's all kind of crap like this going on. And then costs. And then, like you said, unforeseen issues at the mine, a mine collapse, or who knows what, anything can happen. So it's not the best thing to be messing around with. I think as your primary way of allocating capital. Like I said,
Mm,
you have to approach it. I think what I tell people is approach it kind of like a private equity investor. You should do it as what people do is because they're capital constrained, they'll say, well, I'm going to find this favorite company that I like that got hyped or I fell in love with, and I'm going to put my $2,000 into it and hope for the best. And then go on the message boards and follow it on X and know everything about it. Well, that's gambling. What you have to do is take a more of a private equity view and say, I'm going to create a basket of these things, 8 to 10 names, with the understanding that probably 5 or 6 of them probably won't do anything. 2 or 3 will do okay, and maybe 1 or 2 will do
Mm.
exceptional and then give you the outsized returns. That's how I advise people to approach this. But if you only have 2 grand, how are you going to do that? And so a lot of times people are capital constrained, so they have this tendency to just, I mean, most of this is just done on emotional and gut feeling and
Mm.
rumor following and stuff like that. So that's what I've found, that most people are not approaching this in the correct way,
Or they
which
don't
I don't
even
like.
calculate anything about what the project could even
Well,
do economically, right?
yeah, they don't even know anything about mining. They don't even do the basics to try to even learn what kind of deposit I mean, you're starting to get into, real work now, and most people
Yeah.
just aren't doing that. So,
Mm. And it's always a good way to learn about other people's mistake. Get an idea, and have this as sort of also learning experience in a sense, or at least be aware of that. So what is, from your perspective, has been a very expensive lesson from many years of being in the resource sector, and perhaps people should remember while the times are still, as one might say, bullish. This changes. Yeah.
so when I talk like this, like people come back in the comments and like, who's this guy I think he is? He's talking down to us. I'm not talking down to you. I'm 58 years old and have went through all of these lessons myself. Okay. And many people told me things and I didn't listen to them. And so if you're traveling down a road that somebody else has already traveled and you see that they leave signs for you or warnings and you disregard them,
You
then
better
it's like,
appreciate those warnings, though.
yeah, it's like one of my mentors told me, you can learn the easy way or you can learn the hard way, but you will learn. Okay.
Mm.
And it's easier to learn from somebody else's mistakes. So I don't try to talk down to people. This is all these stupid mistakes and all this dumb stuff I talk about is stuff that I did when I was younger. Okay.
Mm.
And so the most important asset that most people have, especially younger people, is time. Time cannot be replaced. If I could have all the knowledge I have now, I would give all my wealth, every single cent. I would just throw me out in the street with underwear only and nothing. And I have all my knowledge, but I'm 18 again and I have 60, 70 years in front of me. I would make that trade today. Okay.
Mm.
Because the effects of, having that wisdom and discernment and learned ability is irreplaceable. That's a lifetime of knowledge. And so I learned the hard way. Then I started learning the easy way. And so that's what I try to tell people. So my biggest thing is most people is, I hate to say this, but stay inside your circle of competence, and understand that you're playing a long game and that your goal, if you look, I've said this before and people don't like this. The average person should just take their money and put it into a low cost world equity fund that rebalances every year and just leave it alone and go on and live their life. Go to
It's
football
just
games, go
alone the time
fishing.
constraint, right?
That's right. And
Basically.
let time compound the wealth because you don't have look who you're competing against, the smartest, craftiest, financed people in the world. I give this example, people that are analysts for like Costco or Walmart, they fly drones over the parking lots to see how many people are going in. I mean, I'm just giving an example. Who are you competing with? You know what I mean? You're competing with the smartest, best, well financed people in the world. So what's your advantage? And so I still think that that's not going to dissuade people. Obviously, people are going to scoff and say, well, I'm smart. I know what I'm doing. I don't care what this idiot says. So they're going to go off and do it anyway. So my view is, well, then if you're going to do that, make sure that you understand what you're getting involved with before you get involved. Understand the difference between investing and speculating, and understand that you don't have a profit until you sell. Okay, and this is the problem. People
Yeah.
buy, and then the thing goes up. It's very exhilarating and fun and egoistic. It feeds your ego
I
when you
mean, you
buy
have
it.
to experience it one time, right? I mean, you
Exactly.
can't become good in this and not have it experienced once, right? Have a big
Exactly. So
winner and then perhaps lose it all, right?
exactly. So this is something. I mean, I tell the story. I mean, I worked in this refinery when I first started got out of the military, and it was during the tech bubble, like 25 years ago. And all these guys that worked there were all kind of chumps. That half of them didn't even have educations, but they were in the right place at the right time. Most of them were millionaires from tech stocks, and I was begging them,
Mhm.
"This is a bubble. Sell." I saw people lose $10 million, dollars, a working person that works for wages that had accumulated $10 million because of this tech thing and ride it all the way back down to where they had only like
Yeah.
$90,000. I saw it. And then I was the bad guy because I said that this, you know, so don't be that person. And it's hard to fight because what's going to happen is you're going to have a junior mining stock that goes up 2, 3, 400%. You're going to think, oh my God, maybe it'll go up 1,000%. If it goes up 1,500%, look where I'll be. I don't even have to work for 2 years. I could
Mhm.
go to Cyprus. I can go to India. I can do whatever I want. I can go to Thailand. Don't think like this because until you sell, you don't have that money. And so understand, keep it in your mind. Hey, the average return over time with dividends invested is 9% a year. If I am fortunate where I have a multi-bagger or excessive profits, it's not a profit till I take it. So I think that's very instructive. And like you said, we can talk about this all day. We can talk about
Yeah.
psychology. People have written about it until you experience it because it's so easy to get carried away in this. I don't. I'm almost unemotional about these things now,
Mhm.
and it doesn't really affect me. And I don't think that I'm some super genius because I'm in the right place at the right time. And
In
that,
a way, it's almost a price to pay if you want to become a better investor. I mean, some have maybe luck and you know and maybe outside advice, a mentor, and they had it easier and they already knew, okay, that's where I should pull, right? But in a way, I mean, I know so many people, everybody that is doing amazingly, right, has had at some point these times where it was like, oh, my portfolio is up so much in 2 years. I just started out, and then it all comes crumbling down once the cyclicality turns again, right?
I mean, I kind of tell the story like even Stanley Druckenmiller, who's kind of like a virtual mentor. I mean, I don't know him, but I read everything. I mean, he
Mm,
got caught up in this during the tech bubble, right? He got out, he sold. They made a tremendous amount of money. That's when he was still working for Soros, and things kept going up, and he couldn't help himself.
yeah.
He of course he waited. He waited. Oh, I can't. People are still making money. Blah blah. He had already made his year, made his decade, and he got back in right at the top, and he got like 40% losses. So it can happen to anybody. And I think, like you said, maybe it's almost kind of like a rite of passage that you have to go through, and
Mm.
you either survive it and come back stronger and say, I'm not going to make that mistake again because I got my ass whooped so bad, or
Yeah.
you say, you just keep making the same mistake over and over. That's what I see. That's what I try to talk about. And I know people get frustrated with me because they think, oh, I'm some guy sitting here like on a rock with my legs crossed, like I think I'm some kind of no. Believe me, I've made all
It's
these
the
mistakes.
reality. Yeah, I mean, it's
Yeah,
reality. There's nothing you can argue against it, right?
exactly. So
And yeah, I mean, we're sort of getting towards the end of our interview. So, is there anything you want to perhaps mention to the audience?
no, I appreciate like I said, I appreciate you bringing me on and having these conversations. I think it's fun. I think that people should really, if you're going to pursue the craft of investing, it is a craft like making cabinets or I don't know, metalworking or whatever like that, that you can see what a real true craftsman. And what I would encourage people to do is, if you want to know something about any subject, you go to the experts on the subject. I tell the story like when I was working in the power industry, we had these guys. I worked for the biggest utility in the United States,
Hmm.
and we had guys that would just sit down on this one floor. They were like subject matter experts. Like if I wanted to know something about a steam turbine controls, this whole guy's 50-year career was around this. He knew everything about
Yeah.
it from his. He could talk for 4 hours about it to make you fall asleep. And so you should do the same thing in investing. It's like who instead of trying to reinvent the wheel, not to say, well, I'm going to be a Buffett guy or I'm going to be this guy, but you'll find commonality around the success and the failures, and you'll find the common denominator, which I think really is controlling one's understanding emotional control, psychological control. And I think these things can't be learned. Like I'm big on like soccer, football. I love the sport, cricket, these different sports,
Yeah.
rugby. And look, I wanted to be a professional baseball player when I was younger, but I didn't have the skill set. And I think a lot of these things can be learned. Like I like to play golf, but I'm never going to be on the senior PGA tour because I don't have the
Yeah.
inherent skills, but I can improve myself, over time if I work. And I think that's what people should try to do is like go to people that have been, look, success leaves clues. If you want, don't try to blindly follow people's 13 Fs when they're trading and put these 13 Fs on the SEC, but go and learn from their mistakes. Learn what, and you're going to find what do you need to do? You need to buy things that nobody else is buying, things that are cheap, things that nobody wants, that have a catalyst to turn. This has been successful. I mean, Howard Marks, all these people say the same thing. It's not what you buy, it's how much you pay for something. And
Mhm.
so if you overpay, I'm sure Palantir's a great company, and so is Nvidia. But if you pay too much for them, it's your chances. It's mathematical certainty you're not going to have a decent return over a 5-10 year period. So that's kind of my last advice. Is kind of success leaves clues. Try to take some time to understand how other people have been successful and the mistakes they've made, and try to avoid them.
Yeah, and it's always a tailored experience, right? I mean, everybody has, as I said this before, I think I'm repeating myself, but essentially everybody has their own strategy, and everybody has their, like, tailored it to themselves, right? And it's something you can only really achieve if you have spent the time. I mean, you can't get to this point without having done years and years and years of experience, and then also tried your best to learn on all kinds of things, topics wise. Yeah.
No, I think that's right.
Yeah. And I really appreciate for the opportunity to talk with you. It was great discussing these things, and yeah, maybe in a few weeks again, right? When when the situations change again, and prices change, and new stories come out, and the world goes around, right? Yeah.
That's
Uh,
it. Nothing but change. So we just got to stay ahead of it and try to take advantage of it.